This will be a briefer briefing than normal. We're going to cover three things quickly: the Fed meeting last week, the embarrassing events in Washington, D.C. from Congress, and what it might mean for investing next year. Let's jump right in. So the Fed came out with a hawkish cut as expected. In their dot plots, they cited higher inflation, higher growth, and lower employment than they were expecting. What's
Steven,
clear is
sorry, Stephen. Do you mean to be on another slide? You're still in disclosure notes.
Yes, I'm in. I should be a couple more in. Hold on. Let me try this again.
Now you show two.
How about now? Two?
Now you're good.
Okay. Are you on the title slide now?
Title slide.
Okay. So here we are. The Fed came out with their dot plots, and what their plot said was inflation's running a little higher than they expected, growth is running higher than they expected, and employment is running lower. I think the real issue for the Fed is getting from 3 to 2 is a lot harder than getting from 9% to 3% inflation. And the Fed's not quite clear on where the neutral rate is, and they're not clear on the impact of President-elect's policies on the inflation outlook. So I think those are weighing on how they're acting and why there was such big dissent inside the Fed last week. But I think the one thing that's clear is the market needs to adjust to the fact that they're not going to get the cuts that they were hoping for, both from this September meeting when they were looking for 7 cuts for the next year, and now from the December meeting where they were looking for 4 cuts. I think they're going to be disappointed throughout. Mark, I believe at the end of the presentation last week, I said that I showed a chart of the CME futures expectations, and I said that we could expect to see those expectations shift to the right. I think that's what came out of this meeting. Mm-hmm. So the dot plot, as you can see here, is kind of all over the board, and it does speak to the fact that people have very divergent views of how strong or how weak the economy is, or how fast or how strong inflation's coming down. But clearly, the idea of multiple expansion is a big driver for the markets next year due to rate cuts has been dashed. There'll be a greater focus on earnings and investments in net interest costs for companies. And you have to bear in mind that for most managers, if you have 15 years experience in the business, for most of that time, you've known zero interest rates or negative interest rate environments, and you've had the support of multiple expansion throughout, which has carried a lot of zombie companies throughout the last couple of years. And I think that's led to better returns for them than they should have received. What I believe you're going to start to see is a bigger divergence between the haves and have-nots in the corporate area, and those that have the financial wherewithal to continue to make investments, pay down their debts, and continue to invest in growth, and growth and productivity in this period will be the winners. So the Fed came out and said the economy is quite strong. The inflation is a bit of more of a fight to get down to the 2% level, but employment is not a concern right now for them. So I think they're in a spot now where they have to hope that the policies of the new administration don't exacerbate an inflation problem that lets the economy continue to move forward. But then we had the fiscal fight in DC, which gave us a good look into what certainly the next quarter is going to look like as they try and figure out how to fund the government and how to put through tax cuts and mass deportations, what that impact will be on the economy. But I think we also got a glimpse into the fact that the president-elect is going to have some challenges with his agenda, as the majority, the mandate that he thought he had with the sweep of both the House and the Senate might not give him the cushion he needs to get everything through that he'd like to get done, as it appears that more and more Republican congressmen are concerned about things like the debt and the deficits. And that's going to make his agenda of extending the tax cuts or lowering taxes and delivering on his immigration promises even more difficult. But I do think there is an element that gets underappreciated, which is the fact that the U.S. has seen energy prices come down, has massive deregulation coming. And even if we only get tax extensions of the 17 cuts, those will help drive growth. At the same time, we're investing massively in productivity growth. So I think there are some offsets to this, but clearly getting his agenda through Congress is going to be much more difficult than people thought the day after the election. Like many nations, we have a math problem, and the math problem is we are spending too much, bring in too little, and have too big a deficit. And as you can see from the chart here, you get a good sense of how you saw expenses really jump in 19 and have continued to stay at a kind of an elevated rate. And while receipts have moved up, they didn't quite move up with the same enthusiasm. And that led to surging deficits. And now we have net interest costs in excess of what our defense spending is. And there is a wake up in DC that we have to get the math problem solved. I think Musk and the DOGE effort is going to struggle to get to 2 trillion. But I also think the idea of slowing the rate of spending increases, making it harder for people to play games with the government spend is going to be one of the key elements that helps get us to be more productive and makes it one of the important shifts that I think is going to go on, which is really a shift that we've seen since the financial crisis, where fiscal and monetary policy has driven the economy forward rather than the fundamentals of the underlying economy and businesses. And I think we're about to experience a handoff from the public sector to the private sector, which will be quite healthy for the U.S. This is a chart of capital expenditures. And as you can see here, CapEx has grown from 2010, where it was about $3.5 trillion, to now where it's close to 8.2 trillion today. Much of that increase has come in the last couple of years, where you saw CapEx go from, just around 5.5 trillion in 2020 to 8.3 trillion today, almost a 45% increase or more in that period. So you're seeing this handoff go from the government crowding out private spending to now where the private sector has to put their money to work with a much higher return on investment target should you get more productive spend coming back and actually lead to increases in productivity, which we're running about 2% productivity, a little bit higher. If we can get that in the 3 to 4 range, you will see a significant improvement in economic outcomes here. So one of the big positives. I think the other thing that's been underappreciated in the markets this year, and for a while I certainly was in this camp, is how consumer net worth has risen to really record levels. So since 2020, consumer net worth is up 50%. And now you have boomers controlling about $80 trillion of what is now estimated to be, this is through Q2, but to date, it looks like consumer net worth is approaching $175 trillion. And when you think back to 2010, where it was under 60, a massive increase in consumer net worth. And the fact is that you have these boomers who are now either retired or rapidly entering retirement, not earning incomes, but in spending modes. And this is one of the things that's really helped drive the economy forward. And if you just look from 2020 forward, where we were looking at basically $108 trillion of consumer net worth, and now 4 years later, 5 years later, we're looking at close to $175 trillion of consumer net worth. You can see the spending power that's fueled. Now, I appreciate that it's not evenly allocated, but this money will be moving either to heirs, to charities and the like. And that's actually one of the big supports for the system, even with all the pain that's being felt by so many in the population all around. And I think these two areas are really underappreciated. The CapEx growth that we've had since 2020 that you can see here, which has been massive, and the consumer net worth growth, which you can see here, which has also been massive. And that's what's fueling the strength of the US economy, with the support of the lag effects of monetary and fiscal policy, which are starting to wear out. So as we head into 2025, I think the markets were way too complacent following the election. We got a little bit of a dose of that complacency being adjusted last week. I think as we enter into the new year, there is tax selling that will not occur until after you get to the new calendar year to reset the cost base for people. So stuff with deeply embedded gains, I think, will be sold in early January. So I think you expect some selling out of the blocks in early January. I think the other issue is we are going to be in a higher for longer rate structure. It's been a theme I've had at ARS, we've had for several years now. And I think the market getting used to the fact that we're going to not be able to go back to zero interest rates anytime soon means that multiple expansions are not as should not be the drive your investment thesis. It should be about earnings and which companies can deliver solid earnings with strong balance sheets that can continue to make investments in a period where there are a lot of zombie companies that have been carried because of government policies that are going away. I think the bond markets for the first time in a long time are offering reasonable yield opportunities. But I think that's all you're going to get out of the long end of the market is your yield. I don't think you'll see big up or down movements in terms of appreciation in your bond portfolio. But I do believe that the private markets are offering some very unique opportunities there. I would just say whenever anyone's rushing to an area like you're seeing in private credit, you need to be very circumspect about where you're going. And then lastly, there's so much negativity in the world, and it's easy to get caught up in it. That's one of the problems with the media is they've slanted to present the news in a way that just gets headlines, not be balanced. But it's easy to forget we're living in one of the most amazing periods in history of innovation, of change that's going on. The world is going to be so different as we move forward that this is where the big opportunities come from. And I think 25 should be a very exciting year. And from the public market perspective, we can see some positive returns, not like we had this year, but certainly you could make the case for high single to low double-digit returns, which have been the norm throughout our history. So good time to be an investor. Just be circumspect about where you're going and be careful about chasing things that look too good. And then lastly, I just want to wish everyone a very happy holiday, Merry Christmas, Happy Hanukkah, and be safe during this period. Mark, thank you. We'll open it up.
Thank you, Stephen. Well done as usual. Questions? Comments? Everything's clear?
Hi, good morning.
Good morning, Anthony.
Yeah, Stephen, hi, brilliant. Thank you for the year and everything that you do and your insight and clarity and concise delivery. So what is the proverbial gray or black swan? I'm sure that you're all thinking about that intently. If you have any thoughts about that, said more simply, what could and how would it go wrong? And what if the administration to be's engineering motivations and ultimately manifestation of all of that doesn't end well, and there's a rebuttal from both domestically and our global allies and potentially enemies from a economic point of view, not all the other things, meaning geopolitical risk and all those awful, terrible things that could happen, but purely economically, in the simplest sense, a hard landing, meaning, maybe it hasn't happened, maybe this landing hasn't happened yet, in this impeding recession that we thought we'd escaped is lurking in the background, where the Fed has to raise but not lower rates. And what does that do to the seemingly good economy that we have? That was just one thought from where I stand. You may disagree or you may have other opinions. I'd just be curious to hear if that concept resonates and if you thought about how one prepares and plans for that manifests in a portfolio. And if you have any other thoughts or disagree, I'd be happy to hear. Thank you.
I think higher rates are definitely a problem for the markets, but I don't know that it falls in the black swan category or gray swan category. I think the grayest swan is that Trump gets it wrong on how he plays his hand on tariffs and on the wars, and that it blows up on the US and backfires and drives people to China. On the other hand, I'm not sure that driving people to China is helpful to China or the people that it's driving to there, because you got to deal with a different type of bad. If you don't like the US, you thinking you're going to like having China be your backer might not be the answer either. I think the other thing the market might be underappreciating is the fact that China has a playbook that they're going to unleash, and they haven't unleashed it yet on the US, that could lead to negative consequences for the US in inflation that way. Don't know what their playbook would be, but they have had plenty of time to choke off certain industries if they choose to, in terms of cutting off supplies. I think the other issue that we're facing is, how does Europe pull together and move forward? And how do they end up aligning themselves to solve their problems that they have, which are pretty significant right now in terms of economic growth, with their leading economies struggling. So I actually think that the issues are, as we understand them right now, are pretty manageable. I wouldn't be chasing things right now. I guess, Anthony, is the best way to protect yourself. We've had such massive moves in markets this year. You've had some pretty strong rebounds in some of the different areas of the market, both private and public, that I wouldn't be stretching for returns in any way, shape, or form as we move into the new year. I think there's enough opportunity to make money without chasing things. I think those would be the areas I would focus on. And I think there's some safer ways to make money, and better asset allocation this is probably a good time to revisit asset allocations and get it right. I think a lot of people got too imbalanced chasing ideas over the last couple of years. And now that we're going to be into what I think is a more normal interest rate environment, without the support of the government's both fiscal and monetary policies to the same degree, then I think you have to rely on earnings. And that's just back to basic good old investing, finding things that are going to grow at a reasonable valuation that you're not overpaying for. So I think it's more 101 investing than we've had in a long time, because I think we're getting back to a more normal investment environment, even with all the Sturm and Drang geopolitically.
Brilliant.
So,
Thank you.
Stephen, this is an excellent point you just made.
Charles, sorry,
Oh.
I love you, but Michael and Steve have their hands up. Can you
Oh, sorry about that.
hold that thought? Or I'll let you go after Michael, Stephen, and then Charles.
Okay, so Stephen, you mentioned Doge and the effort to get more efficient government, reduce spending. I actually view Doge as a political play to target things that Trump doesn't like, not a serious across the board effort to get our house in order. And I point to Trump trying to get the debt ceiling removed as a counter example to what's being said about Doge. And I'll also point out that historically, given Trump's background, he likes debt, he likes leverage. So I'm not as sanguine as you are about the outcomes from Doge. And the fact that folks like Congressman Roy out of Texas was coming out against the spending plan, the short-term spending plan that Trump had put forward, precisely because it was not controlling spending. We live in interesting times.
Michael, I agree with you 100% on most of Trump's policies. And one of the really hard things about planning for Trump 2.0 is the fact that half of what he says is contradictory. He wants to make America great again, but he wants us to be a big exporting nation. So you want a weaker dollar, which is usually the strongest sign of a strong economy. So he is in conflict with himself on a regular basis. So I just step back from that noise. And
the real question is which half?
Huh?
Which half?
Yeah, fair enough. I look at it differently, though. I'm not looking for massive savings. I think a win for our government would be a return to a slowdown in the growth of spend, and to have people finally look at the waste that's going on. And if you think about private companies that you've been involved in that have gone through these exercises in the past and haven't done them for a while, it is amazing how much waste you find that inertia has just built up. I was on a 4-month project at Mellon Bank in the 90s, which was pretty significant size, that came up with massive savings for the bank that we're laying right there. And I think there are opportunities to find stuff right in front of you, and you pick up a couple $100 billion here or there, and it's meaningful. So I'm not suggesting that it's going to be the cure-all or anything like that, but slowing government spending and starting to make people think twice about how they're spending, whether it's a private or public environment, does matter. So I think that's really more likely the way I would look at it, not that there's a big bang coming. I've made the case that I don't think the $2 trillion is likely in any way, shape, or form.
So, Stephen, Keith?
Yeah, you asked about black swans. I have two that I'm thinking of. The first is going to come from China. Yeah, they're very good at blustering right now and threatening retaliations for whatever tariffs comes out of the U.S. And also, Europe is really starting to put the pressure on them from the EV standpoint. And I think once Trump is in, the tariffs will go up, and the Chinese will not know how to react. They only have economic leverage. They can't really back up their claims, their threats, whereas the U.S. can. And I think that there's some massive issues internally in terms of politics, in terms of social unrest, lack of productivity, and as well, and the inverted pyramid in terms of age. China will look for a way to change the channel in 2025. And I wouldn't be surprised if the Philippines, there's been a lot of tit for tat tension about the ownership of islands and free passage of ships in what the Philippines consider their own territory. And I think it could start there. Taiwan is in a really bad position from a Chinese threat. So I think China is going to start acting up, but they've never had to apply military pressure other than within its own territory. And I don't know that they're going to know how to handle this. But I think that's going to be a dangerous flashpoint for the whole region.
Steve, I know you're somewhat new to us. If you looked up 361 firm and Taiwan, you'll probably see some interesting discussions over the months and years on that point. So we could definitely revisit it. And Stephen, every presidential cycle, there's that report that comes out that
The National Security Plan.
Yeah. Is that something we're going to be seeing, and when?
Yeah, I'm not sure when that comes out. I have to take a look at that one. I think that China could go either way. Actually, I think it could go very negative, or it could actually come back closer to the U.S. In terms of trade. I think that we both have problems that we need to solve together more than we have problems that we need to solve apart. But that may be being a little too hopeful.
Here's my second black sheep. We're starting to see a lot of starting in Germany, intolerance for immigrants that are blowing shit up. And I think in Europe particularly, I think it could quickly escalate into severe social unrest between the natives and the immigrants to an extent that we've not seen so far. I can see that happening. It started in Germany, and I think it could easily spread across Europe, where this African and Muslim immigrants that have come in large numbers are causing or are perceived to be causing issues. And I think that could explode very quickly. That's my second.
Social unrest has been a problem. I think Charles's hand was up next, Mark.
Yeah, Charles, and then Rob. Go ahead, Charles.
Hey guys, good morning. Happy holidays to everyone. Thank you. So quick question for you, Stephen, and this goes in a few parts, but the secondary market, right, which I'll be candid, I've been very, very weary of. With the way that you've been talking about going back to fundamentals and corrections, which is frankly music to my ears, are we going to start seeing a more bearish view or more aggressive view towards the secondary market, right? And being able to see some of those valuations. Perfect example, right? When we talk about SpaceX, all of a sudden going from a 150 some odd billion valuation to an almost 300 some odd billion valuation, with no understanding or comprehension how that happened or how that transpired. So love to understand how that goes.
Can I hit that for a second, Stephen?
I was going to punt it anyway.
Yeah. So in Miami and partly in Naples, you will have a unique opportunity to be with Ken Goldman and Todd Rupert, particularly Ken. Ken is in 150 funds. Ken is super active in that secondary space, and he's always been in and out of our conference, and I think we have, if he makes it to Naples, even better. He has his finger on that, one of the people with his fingers on the pulse of the secondaries market. So and then one of the things, if you were to watch what he has said 2 years ago, last year, Silicon Valley, that spread is narrowed. I think that's fair to say. The arbitrage, why you'd be in secondaries, because if you could get in cheaper into a fund, why would you go into the primary funds? Now I'd be curious for his view where that stands. And then you have Tim Draper, who I think is also going to join us by Zoom. Sort of like we're getting back to basics with venture, has been the message. But
I think we're getting back to a more normal interest rate environment that doesn't give you the ability for everything to work, which we had for too long. And that means that people are going to really have to invest now and really have to research differently than we did at zero interest rates.
And people have to be ready for a 12 to 15-year cycle with venture.
Well, yeah, exactly. And so that's kind of where I went. I mean, we saw, for example, in the quantum space, a bunch of companies who, frankly speaking, are 5 years behind or 10 years behind in technological terms to some of the non-public companies that are out there. And all of a sudden they've gotten market caps in the billions, right? Primarily because people said, well, I want to be in this particular sector, but haven't really done the homework on the industry per se. And so your points are well taken that there is going to need to be some of that reckoning. But do you think, just to sort of dovetail this point, do you guys think there is going to be a correction in valuations when investors start to take on a more fundamentals driven view?
I think if you were counting on rates for your valuation as opposed to earnings or growth, then you will be corrected. I think we're getting to a clearing mechanism. I think as M&A picks up, I think as people accept that that the hawkish cut that the Fed put in means there's not a lot of support coming from the fiscal policy and from monetary policy in the U.S. and Trump's already told you that fiscal policy is not going to be very supportive, that means that earnings are going to have to be the driver for it. And that means that the companies that have been carried along, the zombie companies, are going to have some kind of reckoning. So I do think you get to real valuations coming on a lot of companies that have been carried by the Fed.
But there's still been a valuation hallucination on the AI side, so that's part of that reckoning. But Rob, Colorina, you want to weigh in here?
Sure. Well, it's sort of separate topic, but thanks, Mark. It's Steve. This comment on some of the international, either instability or policy unrest. I'm just thinking more of Canada, a little South Korea. I think Germany was mentioned, but isn't some of the argument here a tip of the hat to that Trump and what he's going to assemble in his cabinet? Just they're going to be pretty effective in some of these positionings. I mean, I think Trudeau's party in Canada is particularly, if you look at the pro forma, that lack of relationship may cost them. So I think it seems like it would be a tip of the hat to what Trump could accomplish in these overseas relations. What do you think?
Well, I think he's going to take credit for the fact that the U.S. is so important to these nations that his pushing them around is going to bring business back. But I also think he's going to take credit for the fact that a lot of these countries have worked themselves into such bad problems that the U.S. would attract capital from those environments anyway. So I don't think that Trump should get too much credit or too little credit for any of this. I think it just is a reflection that the U.S. is a really strong economy, regardless of who's in office, and where we are right now economically relative to the rest of the world is we are in a much stronger position than most nations, particularly most leading nations. And Canada's in a terrible spot, both economically and politically. And as was touched on, Europe is not in a great spot politically, not in a great spot economically, and in a terrible spot socially right now in a lot of nations. And against that backdrop, you're going to see capital flow to the U.S. continually. And the fact that we have higher rates and a stronger economy, relatively better growth, all work in our favor. So energy independence, and add to it, I think the deregulation issue that Trump's putting out is going to be very big and underappreciated still. The Biden administration regulations were basically 3% of GDP in terms of regulatory costs. That's a lot of burden on companies. Some portion of that's going to go away. So I think it's not going to be as strong a year as we've had this year, but I think the U.S. will continue to do pretty well, and I think the markets will be at least average, if not better.
What is average, though?
Average has been about 11%, Mark, for back to 29. So take 11% in the public markets, it would be a pretty good year.
And what's your Denny's prediction?
Your Denny's at 7,000, which do the math, but from here it's about around there. I think he's in the depending on the starting point, it was in the 10 to 15% return next year.
Okay.
Thank you.
Michael,
that was fair.
Michael Dale, you hand back down.
No, just a quick question. Stephen used the expression zombie companies more than a few times on this call. I'm not sure I heard it before. Is it just simply The Walking Dead? Is that?
Yeah, those they just haven't gotten the memo yet, but they're so great that they will be able to get out of where they are.
Any come to
so
mind
great
off
that,
the top of your
they
head?
will be able to get out of where they are. 43% of the Russell 3000, Russell 2000 index is losing money. So as a starting point, you get a sense right there that you have a significant number of companies in the public markets that are not making money. Think of what we have in the private markets, and it's fine that they're not making money in the privates, but at some point, too many years of not making money becomes a problem. And I think we're going to be opening up to that in both the public and private markets. People want returns sooner or later.
If at ARS or
It will
energy,
return sooner or later.
So someone's trying to ask me a
Steve, quick one
question.
on energy. Can I just
An-
ask Steve
Anthony?
on? Yeah, just want to ask you, Steve, on energy, metals, mining, steel, and the likes, commodities, which have, arguably as a group gone sideways, and which is somewhat illogical given infrastructure, pave, and all the rest. Can you just talk a little bit about that if you have any thoughts? Like,
Yeah,
what
I think
happens now?
I think what happened is everyone came into the year expecting China to stimulate the global economy with their old playbook of, massive infrastructure spend that grows the global economy up. And they actually were much slower and much softer in how they were investing. And I think part of that was because of their financial challenges, but part of that was also waiting to see how the election went. And wanted to save some dry powder for when Trump got in. So I think part of it is the spend being a little bit slower than people thought coming out. I think part of it is some of the uncertainty around tariffs that is creating some distortions in how people think about it. I think in the energy situation, we actually have a pretty healthy supply of oil and gas. I think the one area that you'll see a bigger opportunity coming is in the natural gas space. I think that you've seen it move up. It was up 5% earlier today. Oil seems to be pretty oversupplied. Steel should benefit in the US from tariffs, but hasn't yet because of China's mass producing steel and dumping around the world. So I think some of it's just dealing with China's excess capacity going into the global markets, and some of it is going into the tariffs come in. How that plays out.